We're facing unprecedented degree of uncertainty for businesses in the next couple of years. The evidence is so clear that multinationals are really shifting their profits at a much greater rate than ever before and engineering lower tax rates.
U.S. President Donald Trump has effectively pulled the United States out of the global corporate tax deal. This landmark agreement with 140 countries was negotiated by the last president, but now it's no more, at least in the United States. For more, I'm joined now by Alex Cobham. He's an economist and the chief executive of the Tax Justice Network. Alex, thanks for joining us, but tell us, what exactly has Trump done here?
So look, what Trump's done isn't so much a big shift as a moment of clarity. We already knew, in fact, that the Biden administration couldn't take the US ahead within this OECD proposal. And although, there were around 140 jurisdictions, perhaps 120 countries had signed up in principle in 2021, in practice, only a much smaller number of countries was actually going ahead with either of the two pillars of the proposal. And the US, it was already known, would not be able to join in. The difference, though, is that Trump has said explicitly, we're not joining in, we don't want to, and nobody else can do this to our multinationals. And that's kind of the key point. That's really what's changed. It's the threat that they're now going to carry out an investigation of the tax rules of every other country, looking at how they affect US multinationals. So what we've had, if you go back around 10 years, there's been this kind of global consensus that we need to get better at making sure that multinationals pay taxes in the places where they're actually doing business. So where they're making their sales, where they're employing staff, where they have their capital assets. What Trump is saying now is that if you continue in that direction, trying to make sure that US multinationals in particular pay taxes in the other countries of the world where they're making their money, then the US will come after you. So effectively this flips the script, or it's an attempt to flip the script that we've been following in international corporate tax for more than a decade. The question really is how other countries respond to that. Will they allow the United States to effectively take away their tax sovereignty, to stop them trying to tax the multinationals that are making profits in their countries? Or will they say, look, we don't want to be beaten up. The United States has a big stick. We'll just put our heads down. We'll give up on these tax revenues, at least for the next 4 years. That's the decision, really, that I think the other countries of the world now have to make.
There's a lot of things you've touched on already. Let's pull those threads apart in the next few minutes. But first, let's talk about what the global minimum tax was meant to do. It was aimed at companies that have more than $750 million in profit and subjects them to a 15% corporate tax. And it was aimed at reducing this practice of profit shifting. It was thought that it would generate hundreds of billions of tax dollars, in particular from these entities we've been discussing, multinational enterprises. Alex, is the GMT doing its job?
No. But look, that's not the fault of the United States. That's because the OECD's proposal had really lost a great deal of its ambition. The original idea of the minimum tax was really to make it completely unattractive to shift profits. If you knew that, even if you got your profits out of Germany, let's say, if that's where you're making your money, and into Ireland or into Bermuda or even into the United States, they'd still have to face a minimum of originally it was going to be a 25-28% tax rate, then it became 21 and then 15, even a minimum of a 15% tax rate. Then your incentive to shift away from a country where you might be paying 20-25% is much less than if you can get, say, a zero effective tax rate, as many multinationals often manage to do. But the OECD proposal had already become so weak and complex that, in fact, there were multiple ways that you could get an effective tax rate below 10 or 11%. And we'd already seen, the Swiss cantons, for example, competing with each other to find clever ways to give the money back, even when they had been going to take that minimum tax, to give it back to companies in other forms. And the OECD had basically said that they were powerless to stop this. So in that sense, the fact that the US has now, under Trump, said they're not going to go along with this at all doesn't necessarily make that much difference in practice. But what it does do, I think, is this. We had a lot of countries, perhaps 40 or so, including the European Union, that had committed to going ahead with this and creating quite a lot of complex new rules for companies that wouldn't necessarily have raised a great deal more tax or indeed stopped much of the profit shifting, but they would have really added a lot to what companies have to think about. If that's now not going to be allowed by the US, it's not quite clear how it works in the European Union, let's say. So it's still on the books. It will still apply, at least until some change is made. But you may find that you're effectively being taxed in two different places on two completely different bases in ways that are not compatible. So I think, although the business lobby in the United States has really pushed Trump to oppose the OECD deal, the immediate effect of this for business is going to be much higher uncertainty than they've faced. And that's the thing that business always says to you, we don't mind paying our taxes, but we want certainty. Well, what the business lobby through Trump has now created is, I think, a period that's going to be characterized by much higher uncertainty, at least for the next couple of years.
You've touched on this a little bit, but it does this move from Trump does make me wonder, what does this mean for the deal? Are we going to see other countries bail potentially more than they already have? Will we see a race back to the bottom of low corporate tax rates?
I think we'll see more countries bail on the deal. I don't think we're going to see a race to the bottom, actually. I think there's reasons to be quite optimistic about this. In some ways, Trump's intervention here may have the opposite of the intended consequences. But let me unpack that a bit. In terms of countries bailing, look, already countries were pretty sceptical about Pillar 1. That's not the minimum tax, but the other piece that was originally was around taxing digitalized companies that were making money in a country but didn't necessarily have a physical presence. Pillar 1, due to the intervention of the Biden administration, had already lost most of its ambition. And countries were being forced to sign up to Pillar 1 and to give up on digital sales taxes that they might have had, or other actually better measures that they had in place to make sure that they were able to tax that type of business as it came across their borders. What this intervention does is it clarifies that Pillar 1 has no future. The US won't allow it to be applied to US multinationals, and they're the biggest in terms of the kind of cross-border profit shifters in that sector. So there's no real reason to go ahead with Pillar 1. On the other hand, Trump is also saying, if you have things like a digital sales tax in place, we might come after you for that too. And the House Republicans have already threatened Canada, for example, just as they threatened the European Union for going ahead with Pillar 2, with the minimum tax. So there's kind of nowhere for countries to go if they want to stay on the right side, unless they give up all attempts, really, whether it's within the OECD proposals or unilaterally, to tax that type of cross-border activity and profit shifting by US multinationals. So what does that mean? Is it the end? Well, I don't think so. I don't think this is going to trigger a race to the bottom, just because we've built up over a period now such a consensus, such widespread agreement, because the evidence is so clear that multinationals, including but not only US multinationals, are really shifting their profits at a much greater rate than ever before, and engineering lower tax rates than they've had. Countries, whether that's other OECD countries like the European Union members or the UK, or its lower income countries around the world, their policymakers and their people are sick of not having the revenues to pay for their own public services. the idea that because Trump has come in and said you can't tax US multinationals properly, that everyone will give up on this agenda, I just don't think is credible. So I think we are looking at a form of conflict. And the question is really where that goes. How do countries respond to this? As I say, they could just put their heads down and say, look, we'll give up on these revenues or on fixing these problems of corporate tax abuse that cost us globally, we estimate more than $300 billion a year. Or we have to work together and we have to find ways collectively to be able to resist the kind of threats and countermeasures that the Trump administration is now proposing.
I'm wondering, based on what you're saying and this discussion we're having, how much weight discontent in other countries is really going to carry with the Trump administration? Because from what I understand, by backing out of this, the United States is essentially giving up tax revenue. So why would they really care how disgruntled politicians or people in other countries are about themselves losing tax revenue? It doesn't seem like there's a big incentive here for this heavyweight, the United States, to listen to anyone, frankly.
That's true. And, as we saw in the previous Trump administration, I think it's very likely that this administration will go ahead with budget changes that really increase the size of the deficit, and that are then used as a way to justify cutting quite basic public services. We saw yesterday budget proposals from the House Republicans, which include abolishing the alternative minimum tax, reducing the corporate tax rate even further in the US. So I think it's certainly clear that the US administration is going to be quite happy to give up revenues, even though it has a deficit problem. And to make further cuts to even quite basic public services, all of which has a pretty damaging effect for US citizens. But that's what the government seems set on doing. But thinking about the dynamic with other countries, look, because Trump has been so clear that he is committed effectively to starting a trade war or starting an entire series of trade wars, there's a bit of a limit to how much you can then threaten countries that you're going to start another trade war or introduce another type of trade countermeasure. If you're doing it anyway, they're already thinking, we can already see Canada, Mexico and others talking about the type of retaliatory measures that they'll take against the US. If you're already in that dynamic, there's just a limit to how much you worry about one more type of sanction that the US might put in place. We may as well try and protect our tax base, our tax sovereignty from this attack, because otherwise we might lock in a dynamic where we can never tax multinationals in our own countries again. So given that we're getting beaten up with trade measures and so on anyway, let's go ahead, but let's do it collectively. And I think that's the key. What the Trump administration has done here is probably the biggest push for other members of the OECD, other rich countries, to join wholeheartedly in the negotiations that are about to begin of a UN tax convention. And that's a global instrument that could potentially provide the kind of deal that the OECD has failed to deliver so far, and it can do it without the US taking part. I think that's the key thing. US multinationals are very good at making sure that the US Treasury participates in negotiations if it's going to affect them. This is definitely going to affect US multinationals, and I think what you'll see is the dynamic that we've had of US multinationals lobbying Trump really to blow up the OECD rules, actually switching.
We've seen the tech lobby, social media companies, or I should say tech CEOs and social media CEOs being very personal, very cozy with the Trump administration. We've touched on this a little bit, but do you think that influenced his decision? Are these CEOs in his ear about their tax burden in other countries?
Definitely. But I don't think that's a Trump-specific issue. If we go back to 2016, you had the first OECD base erosion and profit shifting, or BEPS, action plan was agreed in 2015. almost immediately it was clear that it didn't deal with these issues of digitalization. And so you began a process of really looking at the type of options. You also had countries introduce DSTs, digital sales taxes, and precisely at that moment, those companies were lobbying the US Treasury, both before and after the first Trump administration came in, to make sure that there was a global deal, that they didn't face unilateral measures from lots of different countries, that there was a single deal in place. And that continued under the Biden administration. And that was, a lot of the energy behind the OECD's Pillar 1 was on this issue, came from those US tech companies trying to make sure, in effect, that there was something manageable and that they weren't paying what they would have considered too high a tax rate. So they're still there now, and they have, as you say, a very clear line into Trump and the administration, perhaps more obvious power than they had in the Biden administration, but the dynamic is the same, right? These are some of the biggest economic actors in the world, and the US Treasury has historically always been very willing to listen to its own multinationals and then try to make global policy respond to their concerns. So you could say there's nothing new under the sky. It's a bit more obvious to see it happening now, but it's really the same dynamic as before. And ultimately, those companies will be, and those tech leaders will be part of the lobby, I think, that will bring the US to the table in the United Nations Convention discussions, because otherwise their revenues outside the US will be divided up by the countries of the world, divided fairly, I would imagine, but in a way that they have no direct influence over. So they will force the US Treasury to come to the table and try to make sure the deal is as good from their point of view as it can be.
We've been talking a bit theoretically and abstractly about many groups with a lot of initials in their names. So I just want to show folks this map here and hopefully help them understand a little bit more what we're talking about. So the global minimum tax is basically designed to present a united front to some of these global, really mobile, multinational big businesses who have armies of lawyers and accountants and lobbyists, and who can tell them where to move their money, where it's cheapest, and help them dodge tax obligations. Let's take an example, a nameless big tech services company who might be responsible for a 15% GMT in the past, at least in the US. They could, instead of paying that, shift their profits to a low tax country like the British Virgin Islands or the Cayman Islands or the like. But the GMT agreement wants the company's home or other countries where it operates to implement a top-up tax until that 15% figure is reached. Alex, Mr. Trump has described these top-up taxes as retaliations. Are they retaliations? He's also threatened retaliations to the retaliations. What is going on here?
They're really not retaliations. This is about, when you have a headquarters country for multinationals like the US, which is willing to allow profit shifting from their overseas businesses back into the headquarters country, and then not ensure that they are paying a reasonable minimum rate. Other countries, under the OECD proposal, other countries get the right, the countries where the real activity of those multinationals takes place, get the right to top up the tax so that at least a minimum of 15% is being paid. Now, that only kicks in when the headquarters country, in this case the US, is not using the tax right. So it's really a US decision whether they want to take the revenues themselves or allow them to be taken by somebody else. The only way you can possibly see that as retaliation is if you think that US multinationals, US headquartered multinationals, have a unique right to pay less tax on their global operations than any other business would, including domestic businesses in those other countries. Now, I don't think anyone thinks that, and certainly it's not a position that you could defend on any logical basis. So to see that as retaliation just doesn't make sense. But the fact that that's the framing that Trump has used tells you just how strongly the lobbyists have influenced his way of thinking, have told him. And this is what multinationals all around the world have done for decades. They've told their headquarters country governments, it's good for you if we pay less tax elsewhere. And the US, in fact, is one of the biggest losers in our state of tax justice analysis that we do every year. The US consistently comes out as losing the largest amount of money because its own multinationals are so aggressive. It's not foreign multinationals coming to the US and not paying their taxes for the most part. It's US multinationals exploiting the power that they have. So, in fact, the US would gain probably the most from an effective global minimum tax. The OECD proposals are, as I say, pretty weak, but something more consistent that the US could have pushed for would actually deliver the greatest amount of revenues to the US itself. If you were a US citizen facing the problems of public services, the lack of spending on healthcare, on roads and infrastructure and so on, the deep inequalities, all of these things that can only be addressed by more effective taxation, I think you should be out there calling for Trump to participate in a much more ambitious international tax deal. This isn't about retaliation. It's about having effective tax rules that work for everyone to deliver revenues and public services that we all benefit from. And we should be listening to those views rather perhaps than the views of a few tech CEOs.
So, Alex, we've been talking a lot about certainty and uncertainty and the future for some of these really big companies. But ultimately, what does this move mean for U.S. companies operating in other countries?
I think it means a period of very significant uncertainty. One of the things that is very likely to happen is that there will be the introduction of a range of tariffs by the US and then by other countries in retaliation for that. That's going to shift the relative and absolute prices of imports and exports for the US of all of the intermediate goods that US companies that are doing their business in the US that they rely upon, and also the markets that they have overseas. There's a good chance that over time results in more production shifting out of the US rather than in, as Trump has said he's aiming for. But how that shakes out will really depend on the different decisions that are taken, and that's where this uncertainty comes from. That's before we get to the changes in tax that are going to come, because the multinationals are going to have to work through on what's basically a kind of a moving game, right? Lots of different taxes coming in or not coming in different countries, affecting them in different ways or not affecting them, depending. Things being withdrawn that are currently in place, new things being introduced that may or may not result in retaliation in either direction. All of that is going to play out over the next, probably all of the next 4 years, but particularly the next 1 or 2 years. It's going to be almost impossible for US multinationals in particular to make consistent investment decisions with any degree of confidence about the returns on that. That's, in a sense, the kind of the Pyrrhic victory of the multinationals who've been lobbying Trump. What they've won is a period of really quite damaging uncertainty about their own investment, about their own economic prospects. The kind of underpinning that might be a bit more positive, as I say, is that I think this will really force the other countries of the world to engage very seriously in the negotiations of the United Nations Tax Convention, which starts in February. And that will deliver by 2027 on the current schedule something like a comprehensive global agreement. So perhaps, although we're facing, as I say, a really, I think, an unprecedented degree of uncertainty for businesses in the next couple of years, there may be a silver lining that it brings us all to a new period of consistent certainty about tax rules.
Alex Cobham, he is an economist and the chief executive of the Tax Justice Network. Alex, thanks for joining us.